We'll give a few people to trickle in that RSVP'd. We are currently broadcasting live on our social media streams on YouTube, Facebook, and LinkedIn. My name's Carl Holman. I'm the manager of communications here at A&D Mortgage. I don't think we need to see any reminders that we're having this webinar. Let me close off one little software piece. And all right, we will go ahead and get started. I think we've got most everybody here. Right, let me do a screen share so everybody can see. Billy, Alex, do you guys see the presentation or do you see?
I see AD Mortgage
there we
and
go.
AD Mortgage Digest Live.
There we go. All right. So again, welcome everybody. Carl Holman, communications manager here at A&D Mortgage. Today we've been lucky to have both Billy and Alex, Billy Abrams and Alex Susloff, who handle our weekly A&D Digest every Monday, to join us and talk today about the markets, what's going on, and answer any questions that you guys have live. So let's go ahead and go down the ground rules really quick. For those people watching us through Zoom, we have the microphones muted so that we get a clean recording. You can go ahead and ask the questions in the Q&A panel, and then I will compile those once we get to that portion of the discussion, and we'll start presenting them to Billy and Alex to answer live. My one suggestion would be is if you have a question for Billy, type Billy in at the beginning of the question. If it's for Alex, put Alex. Otherwise, we'll presume it's for both, and then we will go from there.
Otherwise, Carl, it's for you.
Yeah, probably.
Yeah, correct.
All right. So again, we're joined by Alex Susloff, head of our capital markets, and Billy Abrams, president of ADM Securities. Gentlemen, why don't you guys introduce yourselves first? Tell us a little bit about your expertise in the capital markets and markets in general. So Alex, why don't you go first?
Absolutely, no problem. Carl, thank you so much for organizing this. Really appreciate you putting this all together and live streaming this webinar for us. Happy to be here with you, gentlemen, Carl and Billy. Once again, my name is Alex Susloff. I'm head of capital markets at AD Mortgage. We run day-to-day pricing on all A&D products. We develop A&D non-QM portfolio products and pretty much take care of all the loan sales on the secondary market and securitization side as well. Back to you, Carl.
Yep. Okay. Billy, go ahead and tell us a little bit about your background.
Okay, well, I'm Billy Abrams. I'm president and CEO of ADM Securities, and so ADM is a sister company to AD Mortgage and Imperial Fund. I started my career trading commodities and became a commodities broker back prior to computerized charting systems that you could have at home, and so I actually started keeping charts by hand, and it's just been a passion of mine my whole life. So I've been involved in capital markets and trading desk, institutional sales, and so again, a passion of reading charts, especially financial markets, and trying to make projections and make sense of things, and hopefully I do that a little bit in my daily updates and with our weekly digest, and try to do a little of that today.
Great. All right. So let's move on. And you mentioned, Imperial Fund and AD Mortgage. So, Alex, why don't you tell people who may not be familiar with us a little bit about the company, where we work?
Yep, absolutely. I also have a feeling like we'll be playing today good and bad cop, Billy, as I will be covering most recent developments and product updates, and you'd be covering the rising interest rate environment.
I'll be the bad cop.
So talking about A&D and its history, I want to give you a little bit of a high overview for those who are not familiar. A&D has been in business since 2005, and main focus of A&D's origination is agency loans, jumbo loans, and non-QM loans. Our conventional programs have no overlays from agencies, as we're a direct seller servicer. A&D is also well known for its portfolio products that are being competitive on the market as far as the guidelines availability and pricing, which is being very competitive these days on the market. Today, we see A&D as being in the top 3 non-KM lenders across the nation. So like I said, A&D, and I believe the presentation went off for a little bit with Carl's being out of the current webinar. So let me give you a little more overview on A&D in the meantime. So initially, since 2005, A&D was mostly focused on bridge loans and hard money loans, and beginning 2014, 2015, A&D started dipping its toes into non-KM market when non-KM market started evolving post-crisis. And A&D's focus was not the like a previous subprime loans, but rather an AAA paper with alternative documentation. A&D is originating owner-occupied loans as well as investment loans. And for owner-occupied loans, we're verifying ability to repay of the customer and following all the regulations that Z requirements. So our minimum income verification is 12 months. We're doing bank statements, we're doing P&L, 1099, WVOE, and asset utilization. As for investment side of A&D production, we're doing pretty much the same thing with verifying income, and we're also doing a DSCR loan, debt service coverage ratio loans, and we are dividing those into 2 categories: the ones that have DSCR ratio over 1 and the ones that have DSCR ratio below 1. Below 1 has a little stricter eligibility criteria, but no floor ratio. Let me go to our geo footprint. Our geo footprint today consists of, by the way, Billy, do you have an idea approximately of how many states A&D is licensed in today?
You're asking me?
Yeah,
I would ask you.
And that would be a great question, and that's why I'm here for. And I wouldn't expect you guys to know that, because I actually checked that number right before our meeting. And also for correspondent business, it doesn't matter at all, because the one who has to have license is actually the correspondent lender, right?
The lender.
When A&D acts as a purchaser of the loan, we don't require to have a license. We require to have a license to originate. So today we are licensed in 34 states, and most recent states that we got licenses in the past week or 2 were Kentucky, Nebraska, and a few other states. I would need Carl's presentation to tell you the exact states. Then let's talk a little bit about most recent product updates that we had. Just last week, we have introduced 90 LTV for our owner-occupied loans on Super Prime program. We used to do 90 LTV before, but during summer, when there were more scrutiny on the house prices going down, investors and the whole mortgage community was more concerned on the property values, and we had to make a temporary cut for 85 LTV, and we're happy to bring it back today. We are expanding eligibility on most of our non-KM programs to the better part, like allowing a little lower FICO scores, allowing a little better loan amounts. And again, loan amounts are going higher because of the house prices going higher. We see FHFA, Freddie and Fannie updating their loan amounts yearly, and we've been through Q3. After Q3, normally at the end of October, they revise the numbers of the house pricing appreciation and increase the conventional loan limit. So you see some lenders, including A&D and some other guys, have increased conventional limits on the loans ahead of time after Q2. But that's the standard that the world is facing housing appreciation, and it usually happens every year, no matter whether there is inflation or not. There is normally a small inflation that is target of Fed of 2%. And I believe, Billy, you'd comment on inflation in more details, your part, but that is natural. Then the house prices are growing, and A&D is adjusting to it as well. Also, just recently, we have updated our lock policy to make extensions more affordable to our brokers and to our community. We used to have 7.5 basis points per 1 day of extending the lock, and today we're down to 2.5 basis points for the first lock, and 5 basis points for second lock, and 7.5 basis points for the third lock. Most recent developments of our quick price. So we're happy to introduce that last week or 2 weeks ago, we have finally launched our conventional programs on our quick price on our website, jumbo programs, and government programs. Please feel free to go there. You can select what type of loan program you're looking for, whether it's non-QM, conventional, jumbo, or government. A nice feature that I really like is that you can play with your rate to see what your payment would be, whether 1/8 higher or lower, what your upfront costs or credits would be, and kind of move down and up the rate stack. Another feature that I believe is very helpful is eligibility limitations. When you're dragging your cursor over there with LTV, for example, you may see how your minimum FICO changes and how your maximum loan amount is being changed. With lower LTV, you can get a higher loan amount, and when you go with a higher LTV, you see how your loan amount cap is decreasing. As for future developments that A&D is currently working on, I would emphasize the AirDNA as a short-term rental valuation. Billy, have you seen AirDNA yet, and how you can evaluate your property rental over there?
I cannot say that. I have not.
When you go out for vacation, do you usually use hotel, or you from time to time use Airbnb as a rental platform?
The truth is, Alex, I go on so few vacations that I'm not the right person to ask about that. But I do. We have an Airbnb across the street from my house, actually. So we've looked through those before. I have. My wife has. But I'm not the expert on that. I'm a workaholic. I don't go on vacations. So.
Got it. So basically, if you can then just estimate how much the houses around yours can be rented out for Airbnb, right? Probably buy another one and rent it out on an Airbnb, being a workaholic, and just make extra cash flow. This feature, AirDNA, this platform allows you to evaluate historical Airbnb rentals, as well as get a rental valuation for a particular property, a particular address, how much that could be, how much revenue it can generate, yearly, monthly, daily, based on the comparables on the market.
Right.
So with this feature, we will be able to introduce short-term rental automated valuations, which would allow our borrowers who's purchasing or refinancing their investment property to base their cash flow on short-term rental property. Because if you, let's say, if you bought a house on a Miami Beach, you'd probably rent it short-term and you can get triple or 4 times multiple of that house. And glad to have Carl back here with his
Yeah,
presentation.
sorry, folks. My router kicked off on me for a few minutes. So I heard, I was listening to you guys, so I heard you were up to the AirDNA section.
I want to say, Alex, you did a great job without that video up there.
Thank you for stalling. Well, let's just go. We'll go back through really quick so people can see. Yeah, the questions about the footprint.
Yep.
Nebraska, Rhode Island, Alaska,
Rhode
Kentucky,
Island and Alabama.
Sorry, Alabama.
Right.
Oh God, please tell me it didn't break into song. Covered the product updates and the quick pricer, and you were here. So.
Yep.
Okay.
So if we go back a little bit, I wanted to comment on AirDNA. So basically, you may see a few parts of the results that we're getting, and on that bottom screenshot, you see, for example, the annual amount that the property may generate already based on the vacation rate. So, for example, this beautiful house in Santa Monica is supposed to be rented 54% of the whole year. So if Billy, you go ahead and acquire that for 46% of the year, you can live there and just maybe do a little more vacations to
There you
Santa
go.
Monica, and then still generate about 272 grand a year. So based on that number, we'll be evaluating property cash flows if that property is in a short-term rental area, or if the borrower has an intention to rent it out on a short-term basis. Can we move to the next slide, Carl?
Yep.
Okay, thank you. HELOCs. That's being discussed for the past months. We're working on this real hard, and we want to implement this as soon as possible. Carl was asking me just yesterday what's the target date. No exact target date, unfortunately, but we're aiming at the end of October. The key highlights that I want to emphasize is there is no income verification would be required there, and no asset verification. That's a big feature. I don't see many lenders out there on the market doing HELOCs like this. We want to close these loans in 5 days, 4 days or so. When I see other lenders are having around 30 to 45 days on the turn times, because they do full underwriting, full doc, they run tax transcripts, and all that takes time. So no income verification, no asset verification. For property valuation, we will be using AVM. If AVM has low confidence score, we would need to go down the waterfall, and we can do either a BPO broker price opinion, or drive-by, or a full appraisal. But if AVM comes with the good confidence score, which is perceived with the AVM value, then what is important? We don't require title policy over there. We will do title cert, but closing is not happening in a title company. That is a huge saving for the borrower as well. Normally, closing in a title company would cost you from 1,000 to a couple thousand or 3,000 for the title work. We will do closing. We'll do e-closing or RON closing with remote online notary in those states where e-closing is not allowed these days. So guys, I highly encourage you to go through your pipelines of the loans originated back in 2020, back in 2021. Go look at the house appreciation chart in each state, each county. Billy, what's the house appreciation was in your community?
Oh, Lord. The houses have shot up where I live. I'm in a part of town where most of the houses in my area are on water, have ocean access. My Lord, they've appreciated so much on an annual basis, and over the last 5-6 years, it's just remarkable. Yeah, and I always tell people, look at a map of the U.S. and we're in a unique area down here. Not even the U.S. We're in a unique area in that houses have access to the ocean in a tropical climate. So they've been astronomically high in our area. Knock on wood.
Well, that's Billy. You're a perfect client for our HELOC product.
I'll call you about that, Alex. We'll see what we can do.
Absolutely. And then the next development is multifamily residential and mixed-use properties. We're looking to start doing, we've already been doing, and some of our partners know that, and closed a few successful loans on 5 to 8 units for mixed-use properties, but we're looking to introduce that on a regular basis to do 5 to 8 units residential houses and 2 to 8 units mixed-use properties.
Cool.
That would be, I believe, Carl, that's it on the product development side.
Yep.
Right now, we go with the bad cop topic.
Yeah,
right?
time for bad cop.
Bad cop. Here we
Big-
go.
big
Hey, Alex,
bad-
look, yeah,
Big
let me
bad
say,
Billy.
well, let me say this. I may not finish this sounding like the biggest bull in the interest rate market, but I think that HELOC program is going to really be a hot item.
Yeah.
We've gone to 40 years of people waiting and being able to refinance houses at lower rates, and even if you can't do that going forward, there's still going to be the HELOCs are going to be the way to get equity out of your home. So anyway, my presentation is more about what the
And
markets
sorry,
have
Billy,
done.
one more thing to add about HELOCs. What's good about it, right? Even if you don't probably need money today, why not to do a HELOC? It's like a credit card. You
Yep.
get a HELOC, you don't need to
Correct.
draw it, right? You can just keep that line open, and then you don't pay interest on it. You don't have any expenses to keep it open. And then if anything happens, you just have that extra line where you can draw funds from.
That's a great point, Alex. I think everyone will. I think that's going to be just a tremendous product for everybody, for us and for all the for the borrowers. So, so as I get into my bad cop presentation here, I've got about half a dozen charts I want to share. We'll go through some of them very quickly. This first one, and I'm not sure you can see it as well as I'm looking at my screen here, where I've got a blown up copy of it. But the chart you're looking at now is a monthly chart of 5-year yields, and it gets you back into the 1970s. I've got 2 labels on the chart that you can, if you can't read them, towards the upper left, 16 1/4 on September 30th, 1981. That was the high yield ever on 5-year. So if you don't like the 5-year at 4%, just think back then it was at 16 1/4. And what we started a bull market then. My opinion is it probably ended on the right side of this chart near the bottom, where I've labeled 19.2 basis points on August 6th of 2020. So you're talking a 39-year bull market where 5-year yields went from 16 1/4 to basically a quarter. And I think several things to make note of on this chart. First of all, if you look at the upper left, coming off that 16 1/4, the 2 biggest rallies that we've seen in the entire bull market were the first 2 rallies, the ones that occurred in the first 3 to 5 years after the yield crest. And in fact, the pullback that separated those 2 rallies was the biggest pullback we saw during the whole time. So extreme volatility in the early part of the bull market. And then beginning in the late 80s, it settled into a stair step down in yields, a new low yield followed by a pullback to a lower high yield, followed by a new low yield, pullback to a lower high yield, so on and so forth, right down into COVID in August of 2020 when we got to 19 basis points. I would also point out that from that low yield in August of 2020, in just 2 years, we've gone back to the yields we were at in 2007. So wiped out 13 years worth of gains in just 2 years. So my point is the volatility that's happening now from those low yields is not unlike the volatility that happened coming off the top. Also, the fact that we have now traded above that high yield that occurred in 2018 before we went and printed the bottom, that's the first clue to me that we probably have ended that long bull market, because prior to that, if you look back and examine this chart, never once did you go from a new low back up through a previous high yield. So anyway, at the bottom of the chart, you see two horizontal lines. And the only reason I put them there, the first one, the higher one, is 2%. The one below that's at 1%. What that chart shows is that it was 2008 before the 5-year ever got below 2%. But more importantly, it was 2011 before it ever traded below 1%. It stayed down there for almost 2 years. And then it traded back above it and pretty much stayed above 1% until February of 2020 when COVID impacted the markets. So unusual times and historically low yields. So move on to the next chart, and the next chart is going to be a 5-year yield chart as well, but it's a daily chart. And what I want to show in this chart, and again, I'll be looking at my master, I can read it better, but this is more how the yields moving up. This is more how this phase of what I'll call a bear market has unfolded. So as you can see in the first half of this chart is yields were just slowly coming back up out of their historical lows, which is something that has to happen. Markets go both ways. The first thing labeled on this chart is 126. 1.263 or a 126 yield, and that was on December 31st, 2021. I only marked that to show where yields were at the beginning of this year. 5-year was at 126. But that's right when yields began to, I won't quite call them accelerating at that point, but that's when the complexion of the market started to change. The 5-year almost got to 2% in February, and then a quick bounce back to 152, and that's labeled on the chart. And that was March 1st. Now, that's shortly after the Russia invaded Ukraine. And what's meaningful about that is treasuries frequently rally on what's called a flight to quality. A war breaking out anywhere would be something to consider for a flight to quality, and I believe that's what that rally was about. But March 1st, it turned around suddenly, and there were multiple things that impacted that turnaround. Inflation was starting to raise its head. Within a week of that low, March 1st, crude oil had spiked up to $130 to $140 a barrel, partially on inflationary pressures, but a lot of that was because, again, the war in Ukraine. And so from March 1st into right on through the spring and into the summer, yields dramatically rose until the next label on that chart. The 5-year reached 359 on the 14th of June. On that same day, the 10-year got to 348. And then from there, we had a really sharp rally. It's 100 basis points. The 5-year went from 359 to 258. The 10-year went from 348 to 252, I believe. What I found interesting about those levels was that in June, when the markets got to 350 roughly, either side of it, Fed funds at that point had been projected. The consensus was by year end they would be at 350. So the markets got to 350 and then they turned around and rallied. And where did they rally to? They rallied to 250. Well, 250 was where Fed funds were at the time. So it was kind of an unusual confluence of market tops and bottoms occurring where Fed funds were expected to be and then where Fed funds were. But come August, inflation kept kicking up. The Fed became more aggressive. It became obvious they were going to be. And from August 2nd, the 5-year was at 258, and 2 to 3 weeks ago it was at 460. 425. The 5-year was at 425. The 3-year I think was at 440. And again, interesting about that. Now everybody has gotten a little bit more bearish. Now expectations for Fed funds are more like 4.25 to 4.5 by year end. And where have the markets gone to? Well, they've gone to between 4.25 and 4.5. I'm not sure I believe that we're going to get a strong rally out of here, but it's interesting to keep an eye on this area. But the thing of it is, what these two charts show you is that yields have started to come up, and they've come out of historically low yields, so they really didn't have anywhere to go but up. And this chart, I've kind of shown the swings and where they occurred and when they occurred. Let's move on to the next graph, which is not a market graph. I'm going to start to look at some of the indicators I think that sent us where we are. So the first one you see here is CPI. It looks like our pictures may be blocking a little bit of it. Had I shown you a chart of CPI that went back 20 or 30 years, it would be a little bit more dramatic, because the peak on this chart was a little over 9% year over year CPI. That was the highest CPI reading we had in 30 to 40 years. The reason I chose to show it on just a 1 year chart is this. This last year plus, that goes into late 20, that chart starts in late 2021. So when yields began to come up in late 2021, it was because CPI was starting to tick up, as you see here. But what interests me about this chart are the horizontal lines you see within each bar. They may show as brown or kind of gold colored. Those are where the expectations were on the release date of CPI for CPI. And so what that chart shows you is that while CPI was rising, meaning inflation was getting worse, it continued to rise higher than expectations right up until one report ago. So not only was inflation bad, but it continued to get worse than expectations. Now, let's go to the next slide. The next slide here is going to be weekly jobless claims. I'm going to have to look to my right because it didn't show up on my screen. The thing about this chart, this is a weekly number, so it doesn't go back that far. But in August, when yields began to really spike up, when we made the run from 250 to 360, what you see is those are those 10 weeks on the extreme right side of that graph. And each one of those, right up until the most recent one, each one of those jobless claims number came in below expectations. So fewer than expected people filing for jobless claims. That carries me to the last graph we're going to look at with regards to markets. Okay, and this will be your non-farm payrolls graph. So non-farm payrolls are released once a month by the Bureau of Labor Statistics. They are the primary measure of our jobs market. And even though you're seeing it tail off, much like these other two graphs, look at the gold line. Only 1 month this year have non-farm payrolls come in lower than expected. So this chart shows something similar to the last one, and that is that the jobs market, while it may be softening, remains healthier than expectations. Let me add one more thing. When I say expectations, these aren't our expectations, mine or anyone. If you have a Bloomberg terminal, you can look and see where the expectations come from. And on the major numbers, there can be in excess of 100 economists that chime in on where they think it'll be. And these are the averages. So these are truly the market's expectations. So what we have here, in my opinion, essentially is a perfect storm. We're coming off of historically low yields. We've got almost historically high inflation, but also inflation that's growing beyond expectations. And at the same time, we've still got a strong jobs market, as reflected by the fact that each month's reports show jobs to be stronger than expected. Keeping in mind that the Fed has two congressional mandates. One is to maintain price stability. It's questionable right now. The other is to maintain as close to full employment as they can. So as long as the job market remains firm and better than expected, the Fed is free to raise rates as much as they need to in order to maintain price stability or achieve it again by driving down inflation. How do they do that? They slow the economy. Eventually, it will reflect itself in worse job numbers. At that time, I'm sure we'll see the Fed go from 75 to 50 basis points, if not sooner. At some point, they'll go to 25, and the storm will be over. But right now, I think we are dealing with that perfect storm. So this brings me to one more chart I want to show, and this chart is, in some respects, it's the one that keeps me up at night and a little bit more confusing than the others. So let me explain what it is. Now, first of all, on the left side of the chart, I've written 1981. Think back to the monthly we showed in the beginning. That's when the bull market began. This is a chart of 10-year yields minus 5-year yields. So it essentially shows the yield curve. And the reason I say that is because if the 10-year yield is higher than the 5-year yield, that's a normal yield curve. When the 5-year yield is above the 10-year yield, that's inverted. I have charts, I keep charts of the 30-year versus the 10-year, the 30-year versus the 5-year, and this is the 10-year versus the 5-year. I would do more, but I don't have data on the others. And they all look about the same. And if anyone wants me to, I'm happy to send out these charts. The horizontal line on this chart is at 0. So that's where the 10-year yield and the 5-year yield are the same. So two things I want to point out. If you see the swings to the left of 1981, and those are times when the yield curve was inverting and going back to normal and going back to inverted. And those look like real extreme inversions. They were about 70 basis points. But realize they were happening when yields were 16%. So the 10-year might have been at 16 and the 5-year might have been at 16.70, which is a pretty significant inversion. But fast forward to today at 4%, with a 4% yield, a 70 basis point inversion would be far more dramatic. But looking forward from 1981, what this chart shows you is that there have only been, we're right now working on the third inversion that is more than just an intra-month spike below 0. So it's rare. And in fact, if you count the number of months, less than 5% of the time since 1981 has the yield curve been inverted. And that includes these couple of months where it spiked down there. The other thing to be mindful of is since 1981, the deepest inversion was 33 basis points. And right now we're at about 22. So what that says is that if this chart and the yield curve are to go back to normalcy, which they will, they always do. The only way it's going to happen, first of all, it's a near certainty that Fed funds are going to remain above 4% for the foreseeable future. They could be 4.25, 4.5, 4.75 by year end. They expect it to go a little bit higher next year, then level off, maybe even start to come down a little. But as long as yields are above 4% for Fed funds, a normal yield curve would mean the 2-year would be higher than 4%. Higher than 4%. It would mean the 3-year would be higher than the 2-year. It would mean the 5-year would be higher than the 3-year, and so on out the curve. So they all need to be above 4%. They need to be staggered above one another. And that sort of means that if you look down the road, the next 6-8 months, a year, it's going to be difficult to expect a really strong rally when you get out 5-10 years. Mortgages are out there as well, and they feed off the 5-year, the 10-year, but there's also the phenomena of mortgage spreads to treasuries. So this is not to say that mortgage rates are going to keep going up. And in fact, I'm going to say right now, the yield curve, even to retain its historical significance, this chart, the curve can remain inverted for another several months. It can get deeper inverted, and that can happen with some rallies going on. But in the long term, when this market finally turns, in the long term, yields are going to have to go up for this spread to get back to what it normally does, and it's bound to happen. So if you think about why, when a yield curve inverts, ask yourself this. Right now, the 30-year is probably trading at a 380. The 3-year is probably trading at a 330 or a 340. How do people buy 30-year bonds to yield a 380 when they can get a 430 on a 3-year treasury? The answer is they don't, and that's why the yield curve won't stay inverted for all that long. Right now, it's more of a function of demand for money and supply of treasuries, and so this feeds the perfect storm I was talking about. The other thing I would point out is this: we may all benefit from low interest rates, but the truth is, if you look at charts, the major troughs in interest rates come amid bad times. They again, flights to quality, bad economies, Fed forced to lower rates to put liquidity in the system. So where you really want to see rates stay is you don't want them elevated, but you also don't want them near 0, because that's the implications of that are ugly. So with that, I hope that's not too much of a bad cop scenario. I will say this: I think we're in the very late stages of the first leg up in this bear market. I would say we've probably seen 90% of the damage we're going to see. I think when it's over, it will have been a 2-year move up in 2+ year move up in yields. I think it'll be followed by a move back down in yields. I don't think it's back to the bottom, but I think it could easily last as long. I think I'd say 1 to 3 years of a recovery and recovery in treasury prices, lower yields. I think a lot of it could be sideways and choppy. I don't expect it to be just a hard rally, but I think the rise in yields is nearing an end. The charts to me look to be pretty mature. And the last thing I'll say is this: the top of the yield market will not come after you read the news that says the top of the yield market is here. We'll see yields start to come back down before we figure out why they did. It's the way the markets work. So that's my bad cop routine. Anybody's got any questions? Happy to answer.
Carl, you're muted.
I just saw that. Thank you. All kinds of technical issues today. So Billy, do you see that it's still going to be bad for a little bit, but do you see that hope that we're turning a bit of a corner?
Oh, I definitely think so. The chart that if you wish to go back and go back up to the very first chart that you put up there, that would be the monthly chart of the 5-year. Now, I don't want to make this about Elliott wave theory, but I do lean on that pretty heavily. And Elliott wave theory kind of says that impulse waves, which are moves in the direction of the trend, are typically 5-wave moves. And most of the action occurs in what's called the third wave, which is the middle of the move. You can look at this chart and look from the 2020 low yield. I mean, to me, I see that as the first little rally and pullback occurred in 2020 and 2021. I think the move up into that yield crest that occurred in June was probably the third wave. The low that came from it on August 2nd was probably the fourth wave. I think we're in the fifth wave. So I believe we're 90%. I'm not going to say for sure 90% of the way through this in terms of yields, but I think that this upcoming year we'll probably see the Fed. We'll probably see the Fed get rates high enough to put the bite on inflation, at which point they'll stop raising rates. They may hold them there for a while. And the curve will begin to come back to normalcy, and that will put pressure on longer dated treasuries. But I think the move up in yields will end. And I think the important thing is maybe the last thing I addressed before, and that is this market will start to improve before it's clear by fundamentals that it did. I mean, in the same way that it started to rally out of March 1st before the bad CPI numbers in the oil market hit, the market tends to stay ahead of the news. So I don't have a real friendly long-term view of the bond market, but I'll say this: having seen interest rates go from 16% to 0.25%. There was a lot of good economies during those times. There were a lot of good housing markets during those times. There was a good mortgage market during those times. Spikes up in interest rates like this cause sticker shock, and they slow things down, but they don't put an end to it. And I think, like I say, I think the move up in rates is nearing an end. I doubt that we're going to see. I would have some doubts that we would see a 5% handle on 5 and 10 years. So I think, again, having come from 0 into the 4s, I think we might be in the handle that stops it. And then once the recovery in treasury prices start and yields begin to come back down, I think it'll be a very protracted recovery. It will not be it won't come down sharply like it went up yields. But I think it'll be protracted and last years, and things will settle down. Sticker shock will go away, and we'll get back to what we're used to.
What do you see, Alex? Because I see the numbers too, that home rent prices are starting to cool down, home prices are starting to cool down, so that means inventory is starting to come up. So interest rates may be a little high at the moment, but they're not historically astronomical where they were 20 years ago. So it's still, people may not feel it's a great time to buy a house, but it's still not an awful time to buy a house.
I agree, Carl. People will still keep buying houses, and it's hard to kind of freeze the economy. We're definitely at some point where people trying to hold on to their cash because they don't know right now whether if you buy a house today, will it be the price for that house tomorrow. And a lot of people remember 2008 when their houses just recently in 2021 rebounds from that drop. Some people who bought houses on a peak in 2008 just got their houses at the same level in 2021. So there is definitely some fear on that. We're, like Vita has mentioned, in that fifth wave scenario, we're at the moment when investors that we see on the market are holding on to their cash, which kind of drops liquidity right of the products. We see Fed stop purchasing mortgage-backed securities, and they're looking to unwind their balance sheet by not reinvesting into it. A lot of foreign investors, foreign institutional investors are not purchasing bonds. So there might be a liquidity issue on the market where there is not enough buyers for treasuries and mortgage-backed securities, which would lead to a higher yields, like it happened in England during last week or so when bank had to intervene. But worst case, and we saw it during COVID times, Federal Reserve they jump in if the times get too scary and there is liquidity issue. But yeah, like we said, we're looking at some turnaround in 2023.
Good. So what short-term advice do you have for brokers to kind of ride through this perfect storm, as Billy likes to call it?
I'll say this about brokers going forward. I think that when things settle down, we get our first correction months down the road, year down the road, settle back down, probably see mortgage rates get back to, let's just say this, because see 5-year get back in the high 2s, low 3s, something like that. I think going forward for mortgage brokers, I think they will be the bond daddies of the last 3 to 4 decades, because you can look at your home buyer in the face and tell them honestly, the longer you wait, the more that mortgage is going to cost you. So I see this as turning into a good time for the mortgage business and for mortgage brokers.
Can't agree more on that. Right now, with the past year of higher rates, we'll see a wave of refinances in the coming future. Right now it's HELOCs. In a year or two, it would be cash out refis and regular refis to a lower rate.
All right, well, folks, if you've got any questions out there, go ahead and put them into the Q&A. I've monopolized you guys enough a little bit, so let's turn it over to the audience and see if they've got any questions. And until they do, and what are the most common questions you're getting these days, Alex? I mean, other than when is this going to end? and after Billy's presentation, where can I get my antidepressant?
We get a lot of questions on some of the materials that we covered today in the presentation. First of all, it's commercial loans. Commercial, by commercial, I mean multifamily, 5 units and over. Those are considered commercial. So basically residential multifamily. That's one of the questions that we covered. Then, of course, rates. What's going on, when to lock rates, how to handle with extensions. Big question today is valuation of the house. There are a lot of appraisers who are inflating properties, and very often we see that secondary valuations, which are required by our guidelines, there's always has to be a full appraisal plus secondary valuation, whether it is a CU score provided by Fannie Mae or whether it is AVM or CDA. That second valuation has to support the full appraisal, the first full appraisal. And in the past months or two, we see that there are a lot of appraisers who may value, for example, a house in a Boca Raton that was purchased in 2021 at $2 million, value the house 4 million, 4.5 million, 5 million. So my recommendation would be there to choose appraisals properly, because in a run to get a higher valuation for the house, you may get the whole loan process screwed up, where you would need to do another appraisal, right?
Mhm.
It's always good to have your own house a little inflated. I can't argue with that, right? When you're a borrower and you're refinancing, you want your house to worth more. But if you get very strange valuation, you should think of it prior to submitting into to the lender.
Interesting.
And Carl, let me chime in about your about the search for antidepressants after my presentation. As a technician, I can only hope to be right more than I'm wrong, and I really do focus on a lot of markets. So maybe the Treasury market's the one I missed.
No, that's why I asked you the turning the corner question, because it is when you start hearing grim numbers, and anybody in this industry is just oversaturated with nothing but doom and gloom news right now. And I think part of why we put this on was to emphasize that yeah, it's not great, but it's been much worse. I mean the numbers you were showing earlier about things happening before the 70s. I mean,
right.
You and I are the only ones here, I think, in this room that can remember what that was like. But
right.
I mean, oil prices are still high, but you don't see supply issues where people are waiting in line for 3 hours to get gas, unless it's because of a hurricane evacuation.
Right.
But yeah, no, I remember sitting in the car for a couple hours when I was a kid, waiting, not knowing what this was about. But
and I'll point out again, if you look at that long-term chart of treasuries, I mean, the first time we broke under 2%, the first time the 5-year broke under 2% was during the economic collapse of 2007, 8, 9.
Mm-hmm.
It was so that was, I think, the subprime crisis, and what followed it was a terrible economy, and that's where interest rates got so low. What happened this time was COVID. I mean, it's the reality is the only time rates are down there is for the wrong reason. Flights to quality, bad things happen, people rush into treasury markets. I think at the end of the day, you look at a 16% in 1981 and a 0% in 2020, and the middle of that's 8%, and even that may sound high right now, but 5 or 6% really is still historically a reasonably good interest rate. It's just it's not what it was. It's not what it was 2 years ago, and it's not what it was 10 years ago. It's somewhere in between. So
it's a little bit closer to what normal probably would have been.
I would think so,
without those little hiccups. So, okay. Well, thank you, gentlemen. I don't see any new questions have come in. Okay. So I want to thank both of you for your insight, analysis, good cop, bad cop routine. And thank those people who have either been viewing us live streamed or here through Zoom. So with that, before I close down, let me close down with my usual, I'm not in such a rush to wrap up. So again, for those of you, if you haven't seen us before, we do have a weekly A&D Market Digest that you can go and subscribe to from our website and get this exact kind of quality analysis from Billy and Alex each week. That's part of the learning opportunities that we have. We also have, as Alex mentioned, the Quick Pricer, especially now that it's been expanded to cover all types of loan products and not just non-QM. In spite of the discussions we were having a moment ago about the appraisals, we do have our own appraisal center with approved AMCs, so they can probably give you more realistic appraisals, as Alex was mentioning. We've got, I believe it's over 20 of them currently. And so every broker can set up an account, order as many appraisals as they want, and go crazy. And then we have AD Studio, which we'll be doing a deep dive into next week. That's our online marketing platform where you can go ahead and sign up, and it functions a lot like Canva. We've got hundreds of pre-approved templates in there for people to design flyers, emails, social headers, email campaigns. I believe there's a couple of PowerPoint presentations in there as well. So you can customize it to your heart's content. You can co-brand it with either another broker or realtor. So there's a lot of flexibility with AD Studio. So like I said, the next Tuesday we'll be joined by one of the masterminds behind AD Studio, and we'll demonstrate how to put some of those materials together. And after that, we're going to suspend the weekly webinar series for a little bit. We're going to go towards more of a monthly special topic, especially since the holidays are coming up and people are going to be quite busy, and it's a little bit of a down in the market because of half the country being under snow. So we'll put a little bit of pause there. But you can go back and review any of the webinars that we've done previously over the course of this year, including this one. So you can just go to the AD Learning Center. It's admortgage.com/learning-center, and go back and see. I think we've got over 30 plus webinars on various topics, from millennial home buyers, rural properties, manufactured housing, all the different non-QM programs we have, Market Digest, and a couple of other training videos about Automated Decision Manager. So there's a lot of valuable resources there for people if they're interested in learning more about other things that we're doing. And then they can always join us on social media if they're not currently watching us there. We do have presences on Facebook, LinkedIn, YouTube, Telegram, which is similar to WhatsApp. You can download it from Google Play or the App Store, and then just subscribe to ADMortgage_bot and get in touch with us any way you can. And then we've got an online forum called Non-QM Exchange that we participate in with most of the major non-QM lenders. So it's a good social community online for people in this community to network, or run scenarios, or get in touch with us if you can't get in touch with us by any of these other methods. And then the most important thing is, if you're not a partner with us currently, I would encourage you guys to go back to our website, admortgage.com, and then click in the upper right corner about becoming a partner with us, and get all kinds of good stuff from us, including our great turn times, advanced information about the new products like the HELOCs that Alex was mentioning. So with that, we can now wrap up. So again, thank you, gentlemen.
Thank you, everybody.
Great presentations from everyone. So we will join you again next week when we talk about AD Studio. Thank you, everybody. Bye.
Thank you. Thank you, Carl. Really appreciate everything.